Welcome everyone to the Kendall Report. Well, it is Sunday night, and we had quite the week last week, to say the least. Major declines across the board, continued to press the lows that we've seen recently, and retesting some things. Friday's action was very interesting. I'll review that here in just a second. But before I do, make sure you subscribe, hit the like button, and make sure we continue to move this channel forward. So let's talk a little bit about this week coming, right? This is the central bank we'll just say Bonanza, is there's probably, I'm not sure exactly what the count is, but most of Asia, Bank of England, everybody is going to be doing something, but in the real terms, everybody cares about one thing. And I did see the Renminbi is actually over 7 now, so the dollar is continuing to surge a little bit. Everybody is right on par with everything going higher. So the question, as we obviously come into this week on the central banks, is it 75 or 100? And I'm in the 75 camp, just to put that out there. Excuse me. I don't see them doing 100. I think a couple of things happened last week when we looked at the CPI. That number came in so hot. Of course, it crushed the markets on Monday when that hit. And then when PPI came in, it wasn't nearly as hot. In fact, it was actually pretty good in real terms. But we didn't really see a positive reaction back or any kind of rebuttal by the markets and any serious buying coming in. Now, we did see, just to talk a little bit about Friday, and I'm going to tie a bunch of stuff together tonight, but on Friday, we did see the market trade down well into that 38.50 and below, and then it snapped back at the close, and in the aftermarket, it was able to print up to 39.02 again. So all of a sudden, that 39 number is still kind of acting as a magnet. You're going to see here a couple of things I go through the presentation tonight, is that there's quite a bit changed. There's quite a bit to talk about. We're mid-month, basically, just a touch over, and I'm going to talk a bit, start to focus in on the end of the quarter and some of these other things that I'm starting to see, and I want to make sure that you folks have some perspective on. So before I go into more on what I think what the Fed is likely to do, let's go and just look back on last week a little bit and then tie together, look at the economic stuff that's coming out this week, and then we'll go back to the Fed before we move on to the technical section. So S&P down 4.8, NASDAQ down 5.5, Russell down 4.5. We saw a bunch of warnings. FedEx was the big one on Friday. They definitely crushed the market. And I joked on, I forget where I was at, joking and talking about something, I think in maybe the live room or somewhere. But I was talking about that basically you would act as if, the markets acted as if FedEx was not going to send deliver another package for a couple years. And I get the negative. There was also Newmont and Eastman Chemical. There were a bunch of warnings last week. And I think there's something going on here from the standpoint of the economic situation. And if you were a CEO of any company, your last thing you want to do when you have earnings coming out or anything like that is to be optimistic and miss that. So I think we're seeing a lot of underbetting here as we come into these. There's not a lot of earnings, but what we saw last week, I think FedEx was just being super cautious. And of course, that crushed other companies around them, and everything is under pressure right now. I think it's almost impossible to find somebody that's bullish, and I haven't been bullish by any means. My expectation has been that we would test some support and hold that, maybe get a bounce back. But let's just keep going here for a second on looking back on last week. We also saw the 10-year actually surge up to into the 350 handle. The 2 years at 385. So everything's just really getting inverted on the yield curve again. And that was the setup, if you recall, going back maybe about 6-8 weeks ago, that we still don't have the full setup. We need to get the Fed funds on the very front end of the yield curve all the way up to 3.5–4%, which I think is where we're going from that standpoint. And I'll just go ahead, and then I'll come back to this when we talk about the Fed and a little bit more on interest rates as I go through, because this week is all about central banks, but really about one central bank, which is the Fed, and the big meeting on Wednesday. Normally I'm in a live room. I may decide to do that presentation or live room on the internet, do a live stream on Wednesday, because I think it's going to be a big report. So maybe we'll all hang out together. I'll let those of you in the live room know exactly what the plan is there. But let's take a look at a couple things. Let's look at the schedule for this week. On Monday, we've got the housing market index coming out. Not a big deal. Expect to be around 47. And we have housing. Housing's in a disaster. Housing starts are expected to come in at 1.2 million. Permits at 1.616. Both of these numbers are down pretty good numbers, or the expectations are for them to be down. We're also coming into, in some parts of the country, we're coming into a seasonality for housing, for it to be down coming into winter months. But in places like Florida and maybe even Texas and the West out here, housing building actually accelerates a lot of times in the winter. And that's mainly because, especially here in Arizona, it's not 114 degrees and you're trying to hammer nails into a roof. So it's a much different situation and see from that standpoint. And there's a lot of these markets are quite big. So it used to be a really strong seasonal tendency before there was big growth on the West Coast and in the, we'll just say in the West many years ago. I go back to my beginnings of my career, but now it's obviously a very big market, but everything is flattening out right now. Phoenix is absolutely getting hammered. Their listings are up about 300%. You're seeing prices drop anywhere from 10 to 15% on housing. So the housing situation is starting to really get under pressure in a number of areas, and especially even in Florida, they're getting hammered there as well. And you're seeing a lot of increase of inventory and time on the market, all those kind of metrics. So the housing starts are a big deal. And then Wednesday, and the reason why I'm setting that up is we have existing home sales expected to be 4.73 million. It was 4.81 last month. I wouldn't be surprised to see that number come in way worse. There's just a lot of slack building in that market, as I just discussed. And then, of course, Wednesday is the big day, which is the FOMC, the Powell meeting, and all of that. And I'm going to circle back to that here in just a minute. Thursday claims, 215 expected, continuing claims 1.403 was last week. I told you the number I'm looking at is 1.5. And just a side note here is that it's amazing that the employment situation just continues to stay so strong in spite of everybody from FedEx, and go down the list, right? Everybody's saying that we're just going to see this entire, the whole economy is rolling over, and it does look like there's quite a bit of pressure coming on. Friday is IHS. No one really cares, but manufacturing PMI expected to be around 50. If it comes in under 50, maybe that will be a negative sign as well, because that will mean that we're in a contraction. Services come out, it's at 43.7. It's already in contraction territory. So we'll see how all these PMIs come out. And the PMIs, manufacturing numbers, everything just looks like they're terrible. And it looks like they'll continue to be under pressure from that standpoint. So let's go ahead and let's come back to the Fed now. I think what we're going to see from the Fed this week is paint the best picture they can, that they're fighting inflation. They're going to stick with that situation. The whole idea of a pivot was ridiculous to start with, and there's not going to be any pivot. They are just hell-bent on continuing down the path that they're on, and they will continue on that path. Even though they really watch the PCI numbers, which are way lower than headline numbers like what we saw in CPI and PPI, but they're still elevated. I just don't think they're going to let up until they see that number drop a bit more. I would say under 4.5%, maybe even 4%. They're going to keep the pedal on the metal. Otherwise, they're going to keep raising these rates as we go forward. And like I said, I think we're destined for a Fed funds rate of at least 3.75% to 4%. And then I won't do the yield curve tonight, but as we come through, maybe after the Fed meeting on Wednesday, I'll go through and just talk more about the yield curve. But in general, I'll mention that again when we get into the 10-year tonight when we review that. But just generally looking for it to get seriously inverted. And, I guess on other news, the president was on 60 Minutes or something and basically threatening China if they go into Taiwan. Just general geopolitical crap. But there's also, I saw something that was kind of shocking to me, is a Ukraine story that Zelensky is asking for air support from anybody that will give them any support. And I don't think they're going to get that, because I think Russia would see that as a major escalation. And I don't know what the consequences of that would be, other than it wouldn't be met very favorably. And that could be the trigger for, a world war. I mean, it's like it appears that Zelensky's billions and billions of dollars he get really aren't doing enough. Anyway, it's not really political. I have no idea what's going on there, other than it appears that there's some folks out there would like to see a major war go on, including Biden, who's out there talking about, and I get that. I'm not totally against it. I'm not voicing any kind of opinion here, but the whole, posturing very firmly against Taiwan just keeps the tensions high. And, that's it from that standpoint. I'm going to mention something real quick tonight. It just kind of came up for me, is that I really think that China's in big trouble economically. And I think that the whole COVID zero scenario that they're painting out there, that their strategy that they're doing, it has, they're coming into this big event government-wise, and the Party Senate, I think it's called. And I think they're just doing this to keep the economy. They're blaming this on the reason why the economy is really weak. And I think it's a mask over lots of systemic issues that they have, from real estate to everything that's going on. So China's at more, I guess, greater risk than a lot of folks would like to believe. I still think there's a lot of issues there that they're trying to mask, and I'm not sure what's going on. I think there's a reason why the renminbi is up over 7 last time I looked here not that long ago. So this is a serious consideration as well, because if if China continues to deteriorate, and it's likely to do so, there's some city there, 21 million people, that is opening up in it. And if you know much about China, I spent a month in China many years ago, but even then, every city had 12, 15 million people. That's just normal. So they have just, they're locking down people. I think they're trying to keep this things somewhat just a little bit inching forward, but they're using the zero COVID as a cover for what's really going on there, which is a disastrous real estate, we'll call it China economic situation. And I think it's just going to get worse from there. So that ultimately, it used to be, you remember the old saying, when the U.S. gets a cold, everybody else gets a flu or something like that. Well, this is, I think, even worse. If China really starts to slow down, I think there could be a lot of issues that come out of this. So the economic scenario that's starting to be painted, not only just in China, but worldwide, is starting to deteriorate pretty substantially. And I'll just go on for just another minute or so on this. When we came in, when we were coming in through June into June lows, if you recall, my expectation was for the third quarter to rally, which we did. I thought we could get as high as 44, maybe 45, but 43 was somewhat of a given. We went to 43.27 on the S&P futures. And of course, we've been straight down ever since, all the way down to Friday's low, basically. We've just been imploding in on the pattern. And there's a serious pattern that's setting up where, like I said, we're basically mid-month, but the next 2 weeks are going to be really critical. I'm going to go through some long-term setup tonight, so it's going to take me probably a little longer to get through the S&P scenario. We saw some numbers. I talked about some key numbers that we held on Friday, but NASDAQ and some of the other markets didn't fare as well. So there's a lot of mixed currents out there, and a lot of things going on, including things going on with the database as well. So let me just review my notes here. I think we're good to go. Let's go ahead and take a look at the Wavetech database, and then we'll move into the technicals. I'll start here with the daily database. And it's at 3693. And of course, 3 sessions ago, we were up around 54, 56, and the magic number 42. We are now below this, basically a neutral type situation. Below 28 is where we start to get into a negative. And so we're looking at, we had 2,827 sell orders for tomorrow morning's open, only 200 buys, a big bias to the downside. And I'll give you the numbers on the weekly, and we had 977 sells. You can see them on the screen here on the weekly models. 977 sells, only 103 buys. And I'll click over here to the weekly stats. And weekly stats show that we are at 32.55% on the intermediate model. So basically, we're down to, on both the intermediate and the short term, we're down to 7 out of 10 stocks having no position or symbols in general. These actually are ETFs, mutual funds, stocks, even bond funds are mixed into on the mutual fund side. And I don't think we own any bond funds anyway. But the point is that we are finally seeing liquidation. We did see the last couple of days I talked about, finally we're starting to see some liquidation on the short-term database. And I'll go back to the dailies here just for a second. We've actually got, let me go back just for 1 second. There were 2 sectors, materials and services, and those are, they're still long. We didn't get any sell signals, but they are all underwater now, down 2.5%, down 5% on basic materials. I think Newmont and some of the other things that happened really destroyed that this is on the, let's just make sure we've got this. Bear with me 1 second. Yeah, that was on the intermediate. On the daily models or the short-term models, we still have consumer cyclical, energy still long. It's up 1%. Consumer cyclical up 3.02%, and services is up. And we had technology, it was still positive, but it's sold out. So as a sector, the technology has rolled over. So we're just seeing everything roll over. And this was the scenario that I was talking to you folks about over the last, we'll just say 2 weeks in general, is that even though the database on the short term was remaining somewhat bullish, there were just several sectors, 5 of them to be exact, that were positive, and most of the stocks that we owned in there were still positive and were in uptrends. Well, that's finally started to deteriorate over the last couple of days. And you can see even here, if you look at there, 2 of the sectors right now, these are the short-term models. Consumer cyclical is normally held for 51.8 days. Tomorrow, Monday, will make it 52 days. So we basically are right at the typical holding period for these indexes. So they're very, very close to rolling over as well. So everything has gotten very mature. Everything is rolled over, and we're starting to get more into cash. As I've said before, if we were to go and open up some of our key portfolios that we run for both institutions and access for some retail customers, most of those are 60, 70% in cash. There's a few things to own, but not very many, that's for sure. And that sets up, I think, a pretty negative tone. The only thing that's been leading me to believe that we might hold around this 3,900 area over the last several weeks has been that the database just continued to hold pretty solid here. Well, that's all changed, and things are starting to deteriorate. And you'll see here in a minute, I think there's a bounce of some sort coming in the markets, but we're materially starting to change the composition of what symbols are actually trending and what aren't trending. And any of you that have access to Wavetech or PortfolioXpert, I'm sure you can see this reflected in your portfolios that you built. So especially any of the institutional firms that we deal with, that is very much so I guess the theme is lots of cash, and it's been lots of cash all year long. There hasn't been, on an intermediate level, we haven't had any buying at all. Matter of fact, we were at one stage we were down around 12-14% bullish. So it's come up to 32 now, but that's still not a material amount of symbols that makes a difference as far as the portfolios or the exposure that we see that you should have in the markets right now. So that's a continuation there. I'm not looking for any major bottoms here. In fact, let's go ahead and get into the technicals, and I'm going to go through some longer term aspects just to set up as we come in through the mid-month. Okay, going into the S&P, we did print down to 3853. 3850, if you recall, was the, I'll show you here in a minute, the monthly, I believe it was S1 monthly, might have been S2. We'll go through that here in just a second. But the pattern that's set up there, what, like I said, was interesting. We closed at the upper end of the range. You see that I have the aftermarket in here. So if you look at this pop-up here, it shows that the high was 39.05. There was actually about a 12-14 handle run after the close. I think the official close was 38.90 and change. So what we are seeing here, we did see some short covering. We're coming back in. We're down 10 handles already. We're starting to see some pulling back into this pattern. And like I said, PPM 1 is a minus 0.16. PPM 2, big time, accelerating at 0.50, and we're flat on the PPM 3. But all the PPMs have, on a daily basis, were negative. If you recall, on 8/23 is when we got the last sell signal from a position that we had. So we've been neutral or negative coming in. We got that little rally that got up to the 41.30 level. Actually, I think it printed 41.75 on the day of the CPI release. There was a big reversal day. So we saw that reversal day. And now what I think the best case that we're going to get here is somewhat of a sideways range. And I'll set this up. I'm going to have to use the weekly numbers to set this up. So let's go ahead and just take a look at the patterns from the weekly. And I'm going to work my way over to monthly, and then we're going to look at the quarterly. So the patterns that is really set up here on the weekly is, this is significant. And I tell you folks all the time that what we're doing here is always driven by the numbers. And I've got new, let me move this over so you can see this. There's some new downside targets you folks are going to be interested to hear about. There's the new downside target right now is, low target is 33.50. Are you ready? 29.70. And low target 3 is right now looking at 27.35. All you guys have been telling me about 36 and 34. I'm going to show you something else here, and I think we're about to come into a very interesting pattern. And in the live room, a lot of you folks are used to seeing this pattern, but the whole scenario that was set up for the quarter, and I'm going to go to the quarterly chart after I go to the monthly, we're still on weekly, is that we were going to get a higher quarter. We're actually up, I think, 2.3% roughly on the quarter. But the point was that we'd get a recovery, and then we would resume the downside. And I'm going to try to do, as fast as I can tonight, a review of the patterns that I set up going all the way back to January. And I'll piece this together when we get to the monthly. But we look at the PPMs, they're flat on PPM 1. PPM 2 is minus 0.32. And that just puts major resistance now at 40.14. That's probably the ceiling on any rally that we see back into the 40 handle, if we can even get that. I think there's potentially a retest of the lows coming from Friday. We've got some challenges yet. I think probably just due to the Fed coming in and doing a meeting, what we'll probably see is some stability, at least into the Powell meeting. Powell's going to try to put a healthy spin on whatever, but this 4,014 numbers, that's going to be the ceiling for this. So let's keep going through the spectrum. Let's go over to the longer term monthly, and this is pretty interesting. I'm going to change the scale so you can see it, this most recent pattern here. We got the rally that I was talking about up to this, the high was 43.44 on the monthly on the near futures, and then we got this reversal. We took out the low, which was 39.69 last month. In last month. So this month we've had a low of 38.53, which was Friday's low. And are we done yet? We'll see. But if you look at S1, this is what the number I was trying to go off memory. 38.67 was S1. The next number is in a 37 handle. That's for this month of the month of September. So there is some pretty substantial downside yet. We've taken out 67. If we get a daily close under there, it's possible we're just going to continue to come down. And there's one savior right around that S2, which is the monthly 40-period moving average. 36.88 is the extreme, and there's still a decent upslope there, but I don't think we see that number. It's possible. I mean, there's a lot that can happen in the next 2 weeks. So, but let's look at the PPMs here as far as that goes. Minus 1.61 on PPM1. I talked about that being the ceiling. We actually traded last month in August. That number was 4,300. So we printed just above it at 43.44. And that PPM at the time was down at a PPM, let me just get the exact number here, was 1.59. So we still have this major negative here, and we're likely to see a continuing grinding. So if we close, this is going to be the key in the next couple of weeks. We close under 39.69. That's last month's low. That's going to be a major negative and suggests that we're going to get more of an inversion, meaning that the markets are going to go down. If we look at the monthly targets, I just told you what the weekly targets were. Monthly targets right now, low target, there's low target 1 is 36.06, which is a retest of the lows of June. Low target 2 is 31.43. And low target 3, 28.57. So that goes in line somewhat with those weekly numbers. I'll talk about those more as we go forward. All right, so now I'm going to go over and we're going to look at the quarterly charts here. And I'm going to blow this up just so you can see this. Just want you to look at the most recent, and what we're seeing here is this is the quarterly bar, and my expectation, I'm going to blow this up so we can just see the bar here. My expectation was to have an inside bar from last month. You can go back and check the videos on that, but my primary expectation was that this month, this quarter would be an inside bar. And like I said, I'm going to go back to the beginning of the year, just a quick review. In January, we had an outside reversal, meaning that we had an all-time new high. We went below the previous month's low, and then we closed lower, which was a reversal. On February, we got a confirmation of that, and we went down into the first quarter. And that set up a bigger pattern, which was the quarterly high-low. So we got a reversal also on the quarter, and then we got a confirmation in Q2 at the end of Q2. Then I said we should get an inside month or quarter, and that's what we're getting right now. And for the next quarter, I'll set that up when we get a little closer. We should potentially take out the lows, which is going to be that. I'm just bringing it up on this chart here. This is actually the cash, not the futures. So this is the cash. It is 37.21 is going to be the low of this quarter. So we'll talk about that in the next couple of weeks. But this is the inside bar. As it stands right now, we're up 2.32% for the quarter. So we did get a rally, like I said, into that 43 handle, and we couldn't get up into these higher numbers. I mentioned that there was potentials for 44, 45. We never came close to that. The reversal at 43.27, 43.34 was a major one, and that was the case there. So anyway, that kind of ties together the whole scenario, and what the, I guess, expectations going forward is this is potentially what I was talking about then, as we had 2 negative quarters on pricings on the S&P. We're going to have an inside quarter, which was the one we're about to finish a couple of weeks out, and then we should get a continuation, and ultimately the goal was for about 4 to 6 quarters down, and it would map out pretty good with what happened way back in the 70s, and I'm just trying to bring this up into the 73 scenario, which flashes us to everything that everybody's talking about, which is stagflation, the inflation with the recession, the whole bit. And that scenario is still playing out as far as I can see on a longer term basis. And certainly we've never been at a more unique time right now from the standpoint of the amount of debt and all the different, I guess, influences that we have right now. And now, for the first time in a long time, the punch bowl is being taken away by the Fed. We got QT, quantitative tightening, not QE. And I don't think, just kind of tying the Fed back in here, I don't think, considering that the Fed is going to pivot back to its old self, is going to happen certainly anytime soon. I'm sure if the economy does decline substantially, that will be the big talk as we come into next year. But I think it's all going to be on the data. I think they will be data dependent, and it will determine whether or not we have, if there's any inflation control. And I'm not sure, I'll just say this, and we'll talk about this more as we come into Wednesday, maybe even on the live stream on Wednesday, is I don't know that raising interest rates is going to change the current scenario as far as inflation goes. It worked back in the day when Paul Volcker was there. I was there. I was started in the markets in 1979, and I was primarily a bond trader back in those days. I started on CBOT, and all I can tell you is that he was very aggressive, and it worked. It broke the inflation back. But I mean, there were times when Volcker raised the rates like 2.5% at one stage. And so back to the Fed, I guess I'll just tie the Fed in here. We'll probably end up talking a little bit more when we go through the 10-year. But the whole bottom line is that there is going to be a lot of pressure on the Fed to beat down this inflation number. Of course, we got elections in, in a few weeks. So that's going to get really intense as well. So there's going to be a lot of noise around this market. So get ready. So let's go ahead and move in and take a look at the NASDAQ. I'm going to stick with the NASDAQ monthly just to give some perspective here. NASDAQ is really super negative. There is some slight upside right here at where we're trading right now. There's going to be some minimal support right at these levels right here, 11,915. We're trading a little bit below it right now. But we look at the market grid, 11,964 is S1. S2 is 11,522, and we've got half a month to go. We'll just say we're in mid-month. So the bottom line is that what we're going to see here is probably maybe some consolidation around this number. Market isn't probably going to just break down hard just at the moment. But like I said, I set up the number the monthly low close number here for the NASDAQ is going to be a close under 12,322. So we're trading below some critical levels here. We do have some support at this 40. It's up at 0.98. So that is going to supply some reasonable amount of support. A lot of times when we get into this type of scenario, we'll get sandwiched between the 10-month moving average and the 40 in this pattern, which would suggest 11,009 to 13,005. And I'm just looking at this number real quick. That number's dropping about 400, so it's going to be right at 13,000. And the high that we printed in last month was 13.8. So far this month, right at 13.12,987. So that's going to be your ceiling as we come into the month of October. And I know everybody talks about the negative scenario around the month of September. October is even worse from that standpoint. All right, let's go backwards here. Have new objectives on the, just came out. We have new objectives on the downside for the NASDAQ. Low target 1, 95.85, 7,900, 6,900. I don't think we see these lower numbers, but it's very possible to hit that minimum number in this pattern. We also had previous fib targets on the downside for 11,006, which we're close to that number. And then the next number after that is 10,240, 9,000. It's in the pop-up that you can see there. The thing that is interesting from the standpoint of the patterns that we're looking at here is that the PPMs are on the weekly are on the, all three of them are in trend mode down. They've kind of lost some of their downward momentum, but there is plenty of downward pressure yet in these markets. So expect to see the absolute, as we come into this week, somewhere around, right now we're trading 11,883, and R1 is 12,133. S1 11.7, so hopefully we stay in there, but there's some potential if we break through S2 to pivot down toward the 11,285. And I would call this week on all of these indexes on the weekly is in a pivot zone, which means S1, R1. If we take out R1, then we'll pivot to R2, and that's really a pivot zone set up. So we'll see what kind of range that we get set up from that standpoint. So final look here, we'll take a look at the daily. Daily's down 0.42. We're getting a lot of pressure coming in. Looks like to me that from a market grid standpoint, we're going to get down. We're at 855. Could see an S2 here daily. A lot of pressure coming in this market. We're by no means out of harm's way. And like I said, we've just got a ton of selling coming in from our database, and we're still already in a protective mode in general. So it's starting to look pretty negative as we go forward. Next, we'll go to RTY, the Russell, and the Russell continues to also be under pressure. 0.2. This kind of flat pattern here is starting to look a little negative, although back to this scenario that I've been painting here when we come into the Russell is it does look like we've got some of the PPMs trying to turn up, maybe get stable. But the absolute best that you could hope for here is a sideways range, staying on the Russell on a daily below the, we'll call it under the 1864, and just looking at the market grid where 1795 is the low so far, probably 1784, 1774. Let's flip over to the weekly. The weekly pattern suggests that we're probably going to get 1774 is the S1 number, 1742. It looks to me that the last week's low was 1782. There's still some pressure, some potential here. We do have, like I said, we have some support showing up here from the standpoint that the momentum's trying to turn up, but we're going to have major resistance at 1835, and then 1883. So any rally, like I said, we could get a couple of day rally into the Fed meeting and see if the Fed can set things up from not necessarily bullish, but from a supportive standpoint. And then the higher end of the range would be up as around 1900. Okay, next we'll go through the 10-year. We continue to climb through this channel here. As I've mentioned several times in the past, two upward targets yet for the 10-year. One is right at 360. Last week we got to 349. We have a fib target 1 at 35.96, fib target 2 at 378. We'll round that off. And it looks to me, as far as the momentum goes, we're starting to stall a little bit, but we have major upward momentum. So worst case is dropping down. If I look at the market grid for this coming week, we're looking at 349.60 is R1, which is a retest of last week's high. Then 354, 360 is R3. The extreme is 365 for this week. So there's, I think, and I've talked about this several times, is that down at the very bottom here is the Wavetech 200. And this indicator is accelerating big time, which means that the 200-week moving average is starting to turn up. And what that means is there is a secular bear market in bonds. Now that's way down here at 170, 173. Okay, but that number is going to move fairly slow, but it'll start over the next several months. It'll start to move up and probably get, up into 2.25, 240 by we come, and that's going to take a while. It'll probably take us into the end of Q1 of 23, possibility of into Q2 before we'll see any of those numbers start to reflect. But meanwhile, this angle of attack is really questionable on a continuation, because we are seeing the 10-period moving average here starting to just stall a little bit, and that will act as a magnet. And that's at around 3% right now, but that is going up. Let me just see here, going up about 4 ticks. So in the next 3 weeks, it's going to be 310, 315 is going to be the bottom end, and I really don't see a lot of downside. Let's take a look at the daily. Daily is starting to stall, and that kind of my expectation looking at the weekly. 335 is going to be major support here. It would take a break below that. The major pivot in the pattern is pretty much where we're just talking 307 on the downside. That's not in play at all. But we are seeing the PPM starting to roll over on PPM 1 and 2. And that just suggests that we're probably going to potentially get down to 335, 320. I don't know what the Fed's going to be able to say to make that happen. But for right now, we are seeing it's starting to stall, and the key trigger will be that 3.35. So that's about 10 basis points below where we are. Nothing's going to happen before the meeting on Wednesday. You can guarantee that we'll still stay well above that. I wouldn't be surprised to see a print toward those weekly numbers I just mentioned. Just a quick look at the yield curve here. Yield curve is continuing to be inverted. We did see a big inversion move happen. This is the 530 and the 1030. So everything on the 530s, the 210s, all of that are inverted. We don't have the 1030s inverted, and I think that ultimately what I've been talking about for a while, like I said, I will go ahead and go through the yield curve expectations probably after the Fed meeting or maybe during the Wednesday broadcast. I'll let you folks know exactly what the plan is on tomorrow night or Tuesday night. Next, we'll take a look at crude oil. Crude oil's up 51 cents, 85.27. Same scenario. Nothing's changed from last week, really. We're just in this sideways range here. PPMs are negative, so there's still some downward pressure here. And pretty much the only place we can pick up any kind of trends or anything is when we go over to the weekly. And the weekly, we come into this week. S1 is 82.65. We've had an 84.80, 85.88. On the upside, 86.87. We also have the 10-period moving average coming in at 89. So that's the absolute cap. If crude ran up to 89, that it would stall there for sure. Not getting above that number. Got PPM 1 minus 0.93. So look for probably an S1 and 82 handle. I've talked about it before. There's some potential for ultimately, it was not that far in the future, for a 70 handle to come out, something under 80. But I know there's been a lot of talk about the Biden $80 put that they're going to start buying back the SPR if it gets down at 80 or below. I don't know why you would do that, but I don't think that will happen, but anything's possible. Let's take a quick look at the longer term. Look at the monthly. And I remember some number of months ago, we go back into last year, I was talking about hitting the 200-month moving average. Well, we did that. We got above it for a little bit. That average is down 0.32, which is a big number. And you can see it's collapsing. That's the Wavetech 200. It's collapsing on that. And all the PPMs are starting to look a little weaker here, even though there's a substantial amount of upside here. 89 is the upward pattern there, but looking at 88.43 is the 200-month, which is down. So right here at 88, 89, that's going to be a peak for this market for a while. And the potential is to come down towards the lower end of this range. We'll have to look at the update, but this month right now, S1 84.87, the low's been 80.75. So actually it printed an S2 monthly 80.14, and then the high has been 89 right into that 200-month moving average. So don't expect to see it get above that. And we're probably going to just trade around in here on a short-term basis. So 89 being the cap and probably 80, 82, 84 extreme on the downside. Next market we'll look at is gold. I'm just going to stick with the monthly. Monthly gold is interesting because we get down to 1661. S3 is 1644. I've been talking about this market really should be at low 1600, maybe 1500. There's really no reason for gold to be part of the dialogue at all. And I just don't see that actually doing much of anything positive. Looking at market grid here, like I said, 1661, we're trading just below S2 on the monthly. S3 is 1644. Let's just go through the spectrum really quick here. Look at the weekly. I talked about that cycle, talking about a cycle low last week. The low was 1661. So far, we're 1676. So if we can hold last week's low, maybe we can get some stability here. But you got major resistance right here at the 1740 level. But let's talk about the PPMs on the weekly here, because we are seeing, this is what I was anticipating going back a couple of weeks ago. In spite of the lower prices, we're seeing that PPM1 is starting to turn up. It's still down 0.24, which is trend mode, but it does suggest that we could see some upside here, but it's going to be very limited, probably to around R1 now, which is 1697. Back to 1700 would be about as far as you could expect for this week. So look for probably an S2, maybe R1. I could print up above 1700, but I don't believe that'll happen. Final market I'll talk about is Bitcoin. It's starting to print through these numbers I talked about. It looked like it was going to hold up earlier. This is the weekly, and this chart, as you know, will update here at midnight Eastern time. But right now we had 22,761, 18,691, and the number that I've been talking about is 18,635. And if we penetrate through that, that's going to be very negative. And just with some of the correlation with the markets, this is not a good sign for equity markets or anything of the sort from that standpoint. If we break down below that, I don't have any current Fibonacci targets on the downside. There was an old number that I talked about, this old pivot, which was basically at 98.40. I'm not going to say that Bitcoin's going to fall in half, but it certainly could. There's a lot of downward pressure building. PPM 1 and 2 are actually, all three are super negative here on that from the standpoint of the trend. These are negative trends. We traded right into the resistance. The 200-day 23,310, we got up to 22.7, so didn't quite get there. We got a reversal off of that last week, and here we are trading down at these critical levels. So look, if that penetrates through, there'll be another swing low, and we're probably going to see more acceleration to the downside. There's really, we can take a look at the daily, but there's not a lot here. Daily sitting here, the STX 19018, we were actually trading through there. Maybe we get a STX buy signal, but it won't mean much of anything. There's just like I said, there's a lot of downward pressure, and it's all being exerted off the intermediate trends. And I suspect that that's the case as we watch these equities trade. I can't imagine at the moment that we're going to see anything positive. I'm going to be shocked if we can get much of a rally out of equities or anything this week. I think we're going to be really just a choppy range. We'll see what happens when the Fed comes. Hopefully, after tomorrow's action, we get through the overnight and through tomorrow's trade. Tomorrow night, I can come up and give you a little more insight. There's definitely a lot of pressure on all these markets yet. Like I said, NASDAQ down 0.46 again. There's plenty of selling in the NASDAQ. Just to summarize what I was talking about tonight, the NASDAQ has actually really printed some really negative numbers. It dropped below my drop dead number, even though the S&P held it. I'm not sure anything's going to hold. Like I said, our database is just basically puking out 2,900 symbols as we come into today. So it looks like the party's coming to an end. We actually gained some pretty decent profits out of some of the short-term trades, but we've never had any intermediate or the weekly trends really kick in. So this is going to be a challenging week. I'm looking forward to some of the volatility and stuff that we should see this week. Hopefully we can find some good patterns to set up. Any of you, just a quick mention, if you're in the live trading room, I'll be there at 1 o'clock tomorrow, 1 to 4, and hopefully we'll get some good trade setups, and we have plenty to talk about for sure. So I'll see you there. And just for the reference, if you don't have these indicators, please get them. I'm about to make a pretty major announcement when it comes to the indicators, so I'll be letting you know some really interesting things, and those of you that already have them will already benefit from that. But there's some pretty exciting stuff that we're coming up with. So looking forward to doing all that. So anyway, folks, thanks for watching. Hit the like button. I got to get those 1,000 likes, and I will see you same time tomorrow night. Thanks for watching. Appreciate it. Actually, Chris, I was never bullish. Just talked about support. You guys are welcome. Have a great day trading tomorrow.